Investing doesn't have to feel like a puzzle. ETFs let beginners own a piece of the whole market with a plan you can trust. In this video, I'll share a simple, repeatable plan you can start today with little money, and you can grow from there. It's not flashy, but it works if you stick with it. First, ask yourself why you're investing and how long you have to grow your money. A clear goal makes a big difference. Are you saving for a home, for retirement, or for a cushion you won't touch for 10 years? The plan here assumes you're aiming for growth over several years, with a sensible amount of risk you can live with. Now, the core idea is a three-fund portfolio built with ETFs. The three funds cover the whole market, both in the US and abroad, plus a buffer from bonds. The beauty is simple. You don't have to pick winning stocks. You own a slice of many kinds of companies, and you ride the long-term trend of the market. Let's break it down into concrete steps you can act on. Step 1. Pick your core ETFs. The first decision is to choose your 3 ETFs. If you're in the United States, a very common starting point is a broad US stock ETF as your core, something that tracks the wider market. A broad international stock ETF to diversify outside the US. A broad bond ETF to dampen risk and provide ballast when stocks wobble. If you're outside the US, you'll look for equivalents, but the idea stays the same. One broad US exposure, one broad international exposure, and one bond exposure. The names matter less than the role they play in your plan. A simple, practical mix many beginners start with is about 60–70% in US stocks, 20–30% in international stocks, and 10–20% in bonds. You can adjust this as your comfort with risk changes. A 60–25–15 split is a good starting point for a balanced approach. If you want to be a bit more aggressive, try 70–20–10. If you're cautious, tilt toward 50–35–15 or even 40–40–20. The point is to pick 3 funds and keep them in a steady ratio. Step 2. Pick the exact funds. If you're in the US, look for a total US stock market ETF, such as one that covers most large and small companies. For international exposure, you want broad international or global stock exposure that includes developed and sometimes emerging markets. For bonds, a broad, high-quality bond ETF is the most stable choice. The exact ticker is less important than fees and coverage. Choose low-cost funds with a long track record, and avoid funds with high expense ratios or complex structures. If you're unsure, start with the simplest option that fits your 3 roles: broad US stock, broad international stock, and broad bonds. Step 3. Set up automatic investing. Open a brokerage account that offers low fees and easy automatic investments. The key features you want are no or very low trading commissions for ETFs, fractional shares so you can invest any amount, and automatic investing so you can pay yourself first. Decide how much to invest each month. Even if you start with a small amount, the habit matters more than the size. For example, you could start with $50 per week or $200 per month. The exact dollar amount isn't sacred, the discipline is. Set your allocation to your chosen ratio. If you pick 60% US stocks, 25% international, and 15% bonds, your automatic investments should split your money in that exact way. This keeps you from guessing or chasing the market every month. Step 4. Use dollar cost averaging, not timing. Investing regularly regardless of price is a powerful habit. If the market is up, your money buys fewer shares, but more important is that you keep putting money in. If the market is down, you buy more shares for the same dollar amount. This approach reduces the emotional pull of buying the dip and selling the rally. It isn't magic, but it smooths out the highs and lows over time. The core truth is simple. Time in the market beats timing the market for most ordinary investors. Step 5. Rebalance once a year. Over time, some parts of your portfolio will grow faster than others. The result is drift away from your original plan. Rebalancing brings you back. Do a simple annual rebalance. Look at your actual allocations at the end of the year. If a portion has grown beyond your target, sell a bit of that portion and buy more of the parts that are underweight. Keep it mechanical. A rough rule is to bring each asset back to its target percentage. Here's a quick example to make it real. Suppose you started with 60% US stocks, VTI, 25% international stocks, VXUS, and 15% bonds, a broad bond ETF. After a year, U.S. stocks surge and now make up 70%, international is 20%, and bonds are 10%. You'd sell some U.S. stocks and buy bonds and/or international stocks to bring the mix back toward 60, 25, 15. It's not you trying to time the market's top or bottom. It's you maintaining the plan you set. Step 6. Watch costs and taxes. Costs eat into returns over time. Look for ETFs with low expense ratios, ideally well under 0.15% per year for broad market funds. The difference between 0.05% and 0.20% in a fund's fee compounds into real money over decades. Taxes matter too, especially in a taxable account. Broad, tax-efficient ETFs tend to be good choices. If you can, place bonds in tax-advantaged accounts like a 401k or an IRA, while stocks can live in taxable accounts if that's your setup. If you're not sure, keep it simple and focus on the core plan first, then optimize taxes later. Step 7. Avoid common beginner mistakes. First, don't try to pick the next hot stock or time the market. A diversified, low-cost ETF plan keeps you in the game with far less stress. Second, don't overcomplicate things. 3 funds are enough to start. You can add more later if you want to tilt toward values, small caps, or international markets, but keep the core simple. Third, don't skip the routine. Automatic investing and a once-a-year rebalance are the backbone of a reliable habit. If you wait to feel ready, you'll miss the small daily wins that compound over time. Step 8. A concrete starter plan you can copy. Here's a practical starter you can adopt today, with options if you want to adjust risk. Core U.S. stock, ETF, VTI, or a similar broad U.S. market ETF, international stock ETF, VXUS, or another broad international fund, bond ETF, BND, or another broad bond fund, allocation options depending on risk tolerance, balanced, 60% U.S. stocks, 25% international, 15% bonds, slightly more aggressive, 70% U.S. stocks, 20% international, 10% bonds, more conservative, 50% U.S. stocks, 35% international, 15% bonds. Automate contributions to match your budget. Start with a fixed monthly amount and a fixed allocation. If you're paid bi-weekly, you can split the contribution to align with 2 pay periods. The exact numbers aren't sacred. The pattern is. Step 9. Build a simple monthly routine. Set aside 15 minutes on a quiet day each month to do 3 things. Confirm your automatic investment happened and check the balance. Make sure your contributions followed the target allocation. Note any small changes you want to make for the next month, like adjusting the amount you're saving or rechecking your risk tolerance after a life change. Then, once a year, sit down for 30 minutes to rebalance and reassess your goals. If your life has changed, new job, a move, a child, you may want to adjust your plan. The plan should serve you, not the other way around. Step 10. Keep the habit, not the hype. The money you save is not a prize for being clever. It's a tool for freedom. The plan you follow for years should be boring in a good way. The real power comes from consistency, not brilliance. The market will swing, your contributions will grow slowly, and your portfolio will build a cushion you can count on. A quick reminder about the mindset behind this approach. Investing with ETFs is not about predicting the future. It's about owning a piece of the market's long-term growth and giving yourself a predictable, repeatable process. It's a practical path for someone who wants to stay invested, avoid drama, and let compound growth work slowly in the background. If you're listening and thinking, this sounds doable, it is. You don't need a fancy strategy to win. You need a clear plan you can follow when life gets busy, a plan that works even when the headlines are loud, and a plan that you can explain to a younger version of yourself. As you start, patience matters more than precision. Your first few dollars are your first habit. The second month's dollars build on that. After a year, your dollars become a system. After several years, the system compounds, and what started as a small routine grows into real financial momentum. Before we finish, a quick recap you can bookmark. Use 3 funds, a broad U.S. stock ETF, a broad international stock ETF, and a broad bond ETF. Start with a simple allocation like 60, 25 out of 15, and adjust as you get comfortable. Set up automatic investing and keep it consistent. Rebalance once a year to maintain your target mix. Focus on low costs and simple taxes. Avoid tinkering with a plan you don't fully understand. Build a monthly routine that takes 15 minutes and a yearly check that takes an hour, not the other way around. If you found this approach helpful, there are a few ways you can support what you're learning here. Like if you're ready to start, and subscribe if you want more practical, no-fluff money tips that you can actually use. Comment below with one step you're going to take this week to begin your ETF journey. Did you choose a 60-25-15 split, or do you want to tilt a bit more towards stocks? Tell me what you're starting with, and I'll tailor the next video to help you move from plan to action. Thanks for spending time with me today. Start small, stay steady, and watch the simple plan you build today compound into real progress over time. If you're listening, take a breath and take the first step now. Your future self will thank you for it. Like, subscribe, and drop a comment to share your plan. I'll see you in the next video.